Maturity transformation, pros and cons for banks. When it comes to banking operations, maturity transformation is a key concept that plays a significant role in financial intermediation. In this video, we'll explore the pros and cons of maturity transformation for banks. What is maturity transformation? Maturity transformation refers to the process through which banks accept short-term deposits from customers and use those funds to provide long-term loans or investments. This practice allows banks to bridge the gap between short-term liabilities and long-term assets. Pros of maturity transformation. 1. Profitability. Maturity transformation enables banks to earn a profit by charging higher interest rates on long-term loans compared to the interest paid on short-term deposits. This interest rate differential helps banks generate income and improve their profitability. 2. Liquidity intermediation. By accepting short-term deposits and providing longer-term loans, banks act as intermediaries between borrowers and savers. This mechanism enhances the liquidity of the financial system by allowing individuals and businesses to access funds for long-term projects or investments. 3. Economic growth. Maturity transformation contributes to the overall economic growth by facilitating the flow of funds from savers to borrowers. Through this process, banks play a crucial role in allocating capital efficiently, which promotes business expansion, entrepreneurship, and economic development. 4. Risk diversification. Maturity transformation allows banks to diversify their risk exposure. By matching short-term liabilities with long-term assets, banks can spread their risks across different investments. This diversification can help mitigate the impact of any potential shocks in the financial markets. Cons of maturity transformation. 1. Interest rate risk. One of the major challenges of maturity transformation is the exposure to interest rate risk. Banks with a significant maturity mismatch may face challenges in managing their interest rate-sensitive assets and liabilities. Sudden changes in interest rates can negatively impact their profitability and balance sheet. 2. Liquidity risk. When banks engage in maturity transformation, they become vulnerable to liquidity risk. If depositors suddenly demand to withdraw their funds, but the bank's long-term assets are illiquid, the bank may face liquidity shortages. This can lead to a potential financial crisis or even bank runs. 3. Credit risk. Maturity transformation exposes banks to credit risk. Long-term loans can be subject to default or deterioration in credit quality. If a bank has a high exposure to risky loans, it may suffer losses and face financial instability. 4. Regulatory constraints. Regulatory frameworks impose various constraints on banks engaging in maturity transformation. These constraints aim to ensure the stability and soundness of the financial system. Banks must comply with regulatory requirements, such as maintaining sufficient capital buffers and managing liquidity adequately. In conclusion, maturity transformation serves as a critical function of banks in the financial system, enabling the flow of funds for economic growth. However, it also comes with inherent risks, such as interest rate risk, liquidity risk, credit risk, and regulatory constraints. Banks must carefully manage these risks to maintain stability and enhance their overall performance. Want to learn more? Claire Trifle on LinkedIn.